Hello everyone and welcome back to the sessions on financial management. So friends, after covering the basics of financial management and the concept of time value of money, we are getting started with a very important segment of your syllabus. In the introductory part, if you would recall, we have learnt that a company would be broadly taking two major types of decisions in business, that is investment decisions and financing decisions. And particularly when you are talking about long-term investment decisions, this topic capital budgeting that we are about to start with is completely focusing on long-term investment decisions. So let me give you one simple point. What is typically required for any decision? For taking decision, what is required? The answer is information is required. If I don't provide you any information and ask you to take a decision, you will not be able to take that decision. Particularly when it is a long-term investment decision, you need to be extremely careful. So you need to have sufficient, relevant and correct information about the decision. Therefore, capital budgeting is a set of various methods and techniques which will help you to provide information. That means capital budgeting is a cluster of various methods and techniques. Applying those methods and techniques, the information that is generated will become the base for taking long-term investment decision. So, capital budgeting in more simple terms you can define as capital means it's an asset, because if you classify expenditure into revenue expenditure and capital expenditure, revenue expenditure means routine day-to-day basis expenditure, and when it is capital expenditure, it is basically acquisition of assets or construction of assets. So capital budgeting is all about budgeting your capital expenditure. In other words, it is all about long-term investment decisions. So let us begin with writing some notes on this capital budgeting, and we have learned a few concepts of present value. We have also learned what is net present value in the basics of financial management. You will find that those concepts that we have learned earlier are going to be applied over here in this chapter as well. So let us begin with writing some notes in the first order. So please start writing with this heading, meaning of capital budgeting. Long-term investment decisions require adequate, relevant and correct information about the project before the decision is taken. The role of capital budgeting is to provide such information as is required for the decision. Capital budgeting comprises of various methods and techniques that can be helpful for evaluating the feasibility of a long-term investment decision. Such methods and techniques are mentioned below. Let us move ahead and note down all those various methods and techniques involved in capital budgeting, starting with payback period, accounting rate of return based on average investment, accounting rate of return based on original investment, net present value method, in short considered as NPV, discounted payback period, profitability index or desirability factor, annualized NPV or equivalent annual NPV, internal rate of return generally known as IRR, then we have modified IRR and concept of multiple IRR. So I am sure you would have finished writing this list of various methods and techniques that are going to be involved in capital budgeting as a whole. Most of these techniques will require a very important information, that is cash flow information. So you may have cash flows arising from the investment. Obviously, when you make an investment, as a matter of returns, you start getting cash flows. So I'm not talking about the profit that you earn from that investment. I am necessarily talking about the cash flows. Now what happens? all the capital budgeting techniques, or I would say most of the capital budgeting techniques, are based on information of cash flows. So it is all about cash inflows and cash outflows. So when you compare cash inflows and cash outflows, particularly on the basis of present values, you will be able to take decisions generally applying methods and techniques known as present value or discounted cash flow techniques. Most prominent one in that, which is included in this list, is net present value method. So just to recall, how do you compute the annual cash flow amount? If I inform you an amount of profit, from that profit you should trace the cash inflows of that year. Obviously the cash inflows that we want should be the cash inflows after tax. That means cash flows after tax, CFAT, is what we want, cash flows after tax. To get cash flows after tax, you need to have a starting point. So one possibility, question can directly inform you the annual amount of cash flows. Another possibility is they give you some other profit figure. Generally they would report you cash flows before tax. Cash flows before tax are nothing but profit before depreciation and tax. If they report you the profit before depreciation and tax, from that you first subtract depreciation, arrive at profit before tax, then subtract the amount of tax to arrive at profit after tax. And knowing one thing, that depreciation is a non-cash expense. Whatever amount of depreciation you have subtracted earlier to arrive at profit before tax, that same amount of depreciation you added back. If you can recall, earlier you would have learnt depreciation being a non-cash expense, it has capacity to reduce your profit, but it does not reduce the amount of your cash flows. So from profit before depreciation and tax, you subtract depreciation, arrive at profit before tax, then from profit before tax you subtract tax and arrive at profit after tax, add back depreciation, and what you get is annual cash inflows after tax. In short, CFAT, that is cash flows after tax. So I'll just show you how to compute that cash flows after tax, and you may please note it down. So as I have mentioned, you may just write that most of the capital budgeting techniques will require the use of a very important information, that is annual cash flows. Determining the amount of annual cash flows, what you can do is get started with profit before depreciation and tax. This will be the most frequent starting point given to you in examination questions. From this you will obviously first subtract depreciation to arrive at your taxable profit known as profit before tax, and from this, when you subtract the amount of tax, you will get the amount of profit after tax. To this you add back depreciation to arrive at annual cash flows after tax. Let us move ahead and now begin with the first segment, that is payback period. Now it is important for anyone to understand what exactly is this payback period. You know one thing, whenever you make any investment, the first criteria that you have is when will you get back your money. So if you ask me to invest my money, my first question would be, today I am investing my money, when will I get back my money? And then I'll talk about how much returns you are giving. But first you tell me when I will get back my money. Period over which I get back my initial investment is the payback period. Let me give you a simple example. Suppose a project has an initial investment requirement of rupees 10 lakhs and the annual cash flows after tax from that project is rupees 2 lakhs. So right now I am investing rupees 10 lakhs and the annual cash flows after tax will be 2 lakhs every year. So obviously how much time would we require? We would require 5 years to cover up the recovery of initial investment, and that 5 years time will be considered as payback period. So friends, to compute payback period, you need to understand that there can be two different scenarios. Right now I gave you a situation where the cash flows were same each year. That means uniform cash flows each year. If the cash flows are uniform each year, what you can simply do is, in that example, if you can go back again and refer, I mentioned that initial investment is 10 lakhs. Every year I am getting cash inflows of rupees 2 lakhs after tax. So what will happen, 10 lakhs is what I have invested and every year I am getting back 2 lakhs. It will take 5 years time for me to get back the entire initial investment. How did I compute 5 years? So in the numerator we have taken 10 lakhs, in the denominator we have taken rupees 2 lakhs every year. As a result, what we get as payback period is 5 years. But this calculation is possible only when the annual cash flows are uniform. If annual cash flows are not uniform, if annual cash flows are different amounts of cash flows each year, then you will have to keep on accumulating those cash flows until you get your payback period. So getting that payback period would be done little differently when the amount of annual cash flows are different. So what I will do is, I'll take a couple of calculative examples for you to understand how to compute this payback period, along with writing some important notes. So based on what we have just discussed, please write under the heading payback period. It is the period over which the initial investment is recovered without taking into account the interest factor. The payback period that takes into account the interest factor also is known as discounted payback period. We are going to learn this at a little later stage. Determining payback period when annual cash flows are constant. So to compute payback period, what you just need to do is get started with initial investment divided by annual cash flow amount, and what you get will be the payback period in number of years. Let us move ahead and now take up a calculative example given in question number 1. Let us read this question first. The cost of the project is rupees 40 lakhs, life is 10 years and the profit before depreciation and tax is rupees 10 lakhs per annum. Rate of tax is 40% and the scrap value of the project at end is nil. Calculate the payback period. Now friends, few important things for computing payback period over here. We first have a need to compute the amount of annual cash flows. So carefully observe one thing. What they have informed is profit before depreciation and tax as rupees 10 lakhs over here. Now once you are given profit before depreciation and tax, you need to know the correct amount of depreciation. What is informed is the cost of the project as 40 lakhs, life of the project as 10 years, and at the end of the life the scrap value is nil. As a result, we find that in absence of any specific information, we would simply assume the application of straight line method of depreciation. So 40 lakhs of cost will be divided over 10 years on a straight line basis. So annual depreciation would work out to rupees 4 lakhs, that is 40 lakhs divided by 10 years. Now because the scrap value is nil, if there was some scrap value, you would have subtracted the scrap value from the initial cost, and then the depreciable amount what you would have obtained would have been divided on a straight line basis over a period of 10 years, and that would give you annual depreciation. So here in this case the amount is going to be rupees 4 lakhs. Now after knowing the amount of annual depreciation, what you do next is you start with the amount of profit before depreciation and tax, subtract depreciation, arrive at profit before tax, rate of tax is given, so subtract tax, arrive at profit after tax, and whatever you get as profit after tax, to that you add back the amount of annual depreciation to arrive at cash flows after tax. And then you know how to compute the payback period, because cash flows over here are uniform over the life of the project. So let us look into how to present the solution of this question. First thing what you are obviously going to do is calculation of annual cash flows, and over here for computing annual cash flows you get started with profit before depreciation and tax, subtract the amount of depreciation. How we got the amount of depreciation, I have already explained you. So profit before tax will be rupees 6 lakhs. Rate of tax is given as 40%. So when you subtract 40% tax, the profit after tax would be 3,60,000. To that you add the amount of annual depreciation, what you have subtracted earlier, now you are adding back. So your cash flows after tax on annual basis would be rupees 7,60,000. Let us move ahead and now compute the payback period. So computing payback period when cash flows are uniform, what you just need to do is initial investment divided by the amount of annual cash flow. Initial investment is 40 lakhs divided by annual cash flow of rupees 7,60,000 every year. What you get as payback period is 5.263 years. That means in 5.263 years, you will get back your initial investment. That is what we call as payback period. Let us move ahead and take the next question, that is question number 2, and let us read this question first. So notice one thing, in your textbook also I have segmented question 2 into 2 parts, 2A and 2B. Let us first deal with 2A. Cost of the project is rupees 40 lakhs. Life is 10 years. Cash flow in the first year is rupees 7,60,000. Now here they have already given you the amount of cash flow. Thereafter, the cash flow increases every year by rupees 20,000 compared to cash flow of immediately preceding year. That means if cash flow in the first year is 7,60,000, cash flow in the second year would be 7,80,000. Cash flow in the third year will further increase by rupees 20,000. So cash flow in the third year will become 8 lakhs and so on. And now you have to compute the payback period. So to solve this question where cash flows are not uniform, how should you proceed? Let us try to understand over here something very important. You will first compute the cumulative amount of annual cash flows. So let me explain how you should do this. First year your annual cash flow is 7,60,000. We have taken the same thing in the cumulative cash flow column. In the second year your cash flow is going to be 7,80,000. That you add to your previous amount of cumulative cash flow and you get 15,40,000 as cumulative amount of cash flow by end of second year. In other words, what you have done over here, 7,60,000 was the total amount of cash flow that you have obtained by end of first year, and then you have obtained 7,80,000 of cash flow in the second year, which now gets added to 7,60,000. So 15,40,000 is the cumulative amount of cash flow that you have obtained in 2 years taken together. Now what you do is, in the third year your cash flow will further increase by 20,000. So 7,80,000 added 20,000, what you get in the third year is 8 lakhs of annual cash flow. That 8 lakhs will be added to this 15,40,000 and what you get is 23,40,000. If you carefully observe, even by end of third year we have not obtained the payback period because initial investment made by us was rupees 40 lakhs. So you take the cumulative cash flow for the fourth year, that comes to 31,60,000, and then fifth year, which comes to exactly 40 lakhs. Notice one thing, that the cash flows each year has been rising by rupees 20,000, and if you add up all these cash flows of 5 years, the lump sum total cash flow comes to rupees 40 lakhs. If the lump sum total cash flow is coming to rupees 40 lakhs, one thing is for sure, you will take 5 years time to get back your initial investment of rupees 40 lakhs. So you can conclude the outcome over here that payback period is 5 years. So this particular question, it is solved. The answer is payback period is 5 years. You have even noted down few important things that I should convey to you. The life of the project was 10 years, but we have stopped over here at 5th year because we obtained what we wanted. If you continue this table ahead for another 5 years, you will not achieve anything because question simply asked you payback period. payback period is obtained in 5th year. That is one thing. So other calculations can be ignored because nothing else was asked in this question other than payback period. Second thing, it is just a coincidence that exactly by end of 5th year we got cumulative amount of cash flows as 40 lakhs. Just a coincidence. Just imagine, is it necessary that by end of any particular year you would get exactly your initial investment? Obviously not. It is not necessary. That is why in this second question I have given an extended part in the name of question 2b, which states that instead of 8,40,000 as the cash flow in the 5th year, what would be your answer if the cash flow was 10,40,000? So you can just understand over here, instead of 8,40,000 in the 5th year, if it is 10,40,000, the cumulative cash flow by end of 5th year would be not 40 lakhs but 42 lakhs. If that is 42 lakhs, obviously you will not need 5 years to get your initial investment. Your payback period in that case would be coming between 4th and 5th year. How to trace that payback period is what we need to understand. So let us see how to solve that part over here. So here is that question 2b, which states that what will be your answer if the cash flow in the 5th year is rupees 10,40,000 instead of rupees 8,40,000. So let us do one thing. First of all, what you would do is you would compute the cumulative amount of annual cash flows for the periods until you get your payback period, or until you get an amount which is equal to or more than 40 lakhs of initial investment. So this time when you come to 5th year, you find that your cumulative cash flow is coming to 42 lakhs. So in that case, one thing is obvious, that your payback period is not 5 years but something less than 5 years, or in other words you can say your payback period would be between 4th and 5th year. So how would you compute your payback period in that case? Let me explain you by some simple calculations over here. So you observe one thing, by end of 4th year your cumulative cash flow is 31,60,000. If your cumulative annual cash flow is 31,60,000, how much cash flow you require to fill up your initial investment? Just 8,40,000, because if 8,40,000 added to 31,60,000, it would give you exactly 40 lakhs. However, the cash flow that we are expecting to obtain in the 5th year is 10,40,000. That means your payback period over here will be 4 years plus part of the 5th year to get not this amount of cash flow but only 8,40,000. So simple logic is, if 10,40,000 takes 1 year time, 8,40,000 would take how much time? So it will be fraction of the year, and that fraction would be basically 8,40,000 by 10,40,000. Time for us to move ahead and look into the calculations further. Payback period, as I have already explained to you, it will be 4 years plus part of 5th year for the remaining cash flow of rupees 8,40,000, and therefore it will be 4 years plus the fraction of the 5th year, and that fraction will be obtained by 8,40,000 divided by 10,40,000. So logically, I told you earlier, once again I would explain now, it takes 1 year time to generate cash flow of 10,40,000 during 5th year. So how long it would take for cash flow of 8,40,000, assuming that the cash flows within the year are generated uniformly. So if 10,40,000 takes 1 year time, 8,40,000 would take how much time? And if you look into that calculation, it comes to 4.8077 years. So please write up this whole thing, and that will be end of the solution.